Good afternoon, ladies and gentlemen, and welcome to today's webinar. The title for today's webinar is Singapore versus Hong Kong. Before we begin, I would just like to make sure that the system is working accordingly. If everyone could raise their hands so that I can see that everyone can listen to me, that would be great. In the meantime, if you do have any questions throughout the presentation, please do put them in the questions section, and we will have a short Q&A at the end of the presentation for all those questions that would be general. For all those questions that are specific, I will contact you after the webinar today and send you replies by email. The presentation will be available to everyone, and I will also be sending this once the webinar is finished. So for those of you that are new to Clayco Group's webinars, I'll just briefly give you an introduction to who we are. We are an accounting and management consulting firm that was started in Hong Kong in 1979. We have grown into the China region as well as into Singapore, and we have 120 employees based throughout these 10 offices. We assist clients on a corporate and business level as well as on a private level. And most of our clients are small to medium-sized entities as well as multinationals. One of our specialities is the fact that we have international desks and have the ability to speak in 7 additional languages. A little bit about myself. I joined Clayco at the end of 2003. And moved to Shanghai, where I opened our first China office. I've been assisting European, American, Australian clients in entering the China market by incorporating their entities, restructuring their existing entities, as well as liquidating them. I'm also co-author of our monthly China Invest.biz magazine, which provides insight into how to do business inside China. Now, when I've been traveling actually over the Christmas period, December and January, and I was meeting with a lot of law firms in Europe who actually informed me that there was a tremendous lack of knowledge on the market about the differences between Hong Kong and Singapore. And it came to my attention that people actually need to be educated about both types of entities because it could be that one jurisdiction would be better for a certain business model versus the other. And I think it's a very informative way of informing people on what are the differences, what you need to consider for both, what you need to consider for maintenance, and to then decide whether a Singapore or Hong Kong entity would fit better into your business model. Usually clients that we have met only know one or the other, but they actually don't know both. And I thought this was a perfect opportunity to explain both jurisdictions, apples to apples, so that it would be a much easier way of making a decision on where to establish first. Now, the easiest way I knew how to present this information was really to go down the list one by one and explain what you need to consider for both types of entities. So to start off with, on a general level, you have the basic legal system, which is based on common law. And there's a lot of misunderstanding that clients believe that actually common law is identical to UK regulations and UK law. Actually, there are slight differences that one needs to keep in mind, and there are slight differences in each jurisdiction. So although the legal system is based on common law, it doesn't mean it's completely 100% following common law. There are slight variations. The type of company to be established would be a limited liability company. The next one is the tax on offshore profits, which is usually the biggest question that is raised by most companies. Now, in Hong Kong, if you are doing offshore business in a fiscal year, then you can apply for tax exemption. And there are certain criteria that you need to follow, which is related to the actual business transactions of the company and where decisions are being made. In Singapore, tax on offshore profits, this is actually based on where your bank account is. So if you have a Singapore company and the bank account is Singapore and all your transactions are considered offshore, you still cannot apply for tax exemption because the Singaporean company has a bank account in Singapore. So ideally, in the case of Singapore, if you want to apply for tax exemption, you can set up the Singapore company and have, for example, the bank account in Hong Kong. That would be permitted if you wanted to apply for tax exemption. Exchange controls, there are none in both jurisdictions. The time frame for establishment, if you want to set up a new entity, is 4 to 5 days in Hong Kong, and it is 1 day in Singapore for the fact that in Singapore you can do the full application online and get the approval immediately. My opinion on time frames, basically whether it's 4 to 5 days or it's 1 day should be of no consequence, because if you are planning to set up your entity, you should be setting it up in advance and not being rushed throughout that process. Shelf companies, this has been quite interesting actually. In Hong Kong, shelf companies are available. In Singapore, and shelf companies are legally allowed to be registered. So in Hong Kong, legally speaking, you're allowed to have shelf companies, and there are corporate providers that hold shelf companies. In Singapore, legally speaking, shelf companies are not permitted, but there are corporate service providers that register companies, structure them, and then keep them on the shelf. So in the case of Singapore, if you do want to buy shelf companies, it would be my suggestion to do a proper due diligence because they are already structured. In both jurisdictions, there is the requirement of a minimum of 1 shareholder and a requirement of 1 director. Bearer shares are not permitted in either jurisdiction. The location of the board meetings can be anywhere in the world. And if you are trying to apply for tax exemption, they shouldn't be in Hong Kong or in Singapore. In Hong Kong, corporate directors are permitted now. There was a regulation that was issued in 2012 that the Hong Kong government is planning in a 2-year time frame to eliminate corporate directors for a Hong Kong company. But there are 22 to 23 bylaws which need to be passed first before this can occur. So the government says that there's a 2-year time frame, but actually it could be even longer, whereby this will be revoked. In Singapore, corporate directors are not permitted. You must have a local director who is a director of the company. The administration, which entails corporate secretarial, accounting, etc., must actually be done in Hong Kong if it's a Hong Kong entity, and in Singapore if it's a Singaporean entity. The paid-up capital to set up an entity is $1 Hong Kong dollar in Hong Kong and $1 Singapore dollar in Singapore. In order to bring cash into those entities, the systems are the same. They would come in as loans. Both jurisdictions require a registered office address. And here I just want to point out that it can be a mailbox. It does not have to be a physical office. It can be a virtual office type entity. In both jurisdictions, you do need to have a company secretary. And in terms of the local director, you don't need one currently in Hong Kong, but you will need one in Singapore. I would just like to mention here at this point that if you have compared fees with corporate service providers in both jurisdictions, you will usually find that Singaporean fees are much higher than Hong Kong fees for the fact that a local director will be needed and will usually be listed in the fee structure. So please do take note of that when you make comparisons between both jurisdictions and how corporate providers create their fee structures. Public filings is an issue that is really becoming an issue globally. Traveling around Europe, it came to my attention that not only on a legal side, but also on a banking side, everything is becoming transparent. And as you can see here, in Hong Kong and Singapore, currently, directors and shareholders have to be revealed. They are listed in the public filings of the company. However, beneficial owners on a legal basis are not declared. However, if you want to open a bank account in Hong Kong for a Hong Kong entity or a Singaporean entity, or even in Singapore to open bank accounts, the banks will require to know who the beneficial owners are of the entity. It is impossible to believe that they will want to not know this. Everywhere around, every jurisdiction around the world is requesting this information. So it's very important to realize this, because we've been getting a lot of clients asking us to set up Hong Kong or Singapore entities basically to hide themselves. But in reality and in daily practice, this really just is impossible, particularly on the banking side. In terms of the annual filing requirements, an annual return must be created for both a Hong Kong and Singapore entity. It gets at this point to be quite confusing because the authorities are actually called very different. In Hong Kong, it's the Hong Kong Registrar, and in Singapore, it's ACRA. And of course, you need to understand who the authorities are in order to be able to compare prices when you're receiving your fees. In terms of audited accounts, in Hong Kong, it's a requirement. If you have business running through your entity, you must do an audit. In Singapore, audits are also required unless you have a revenue of less than 5 million Singapore dollars. But even then, you have to do what are called unaudited accounts. My suggestion to many of you would be, regardless of what stage you are in your market entry, do proper audited accounts. This will help you in the long term, particularly if you're planning on doing any type of M&A. If you're trying to get new investors to invest in your entity, it's highly vital to do proper audited accounts. My suggestion is really from the day that you've opened your entity, make everything transparent and clean so that you have no problems on the banking side, you have no problems on the investor side, and your company can flow easily. It also helps you in terms of budgeting, because then you know from day one, if you do everything properly, this will be your budget on an annual basis. There are government costs to renew your business license. In Hong Kong, it's 555 Hong Kong dollars, and in Singapore, it's 20 Singapore dollars. I'm not sure if any of you know, but Hong Kong lowered its government costs in April 2012. It used to be 2,555 Hong Kong dollars, and the government realized that these costs were actually enormous compared to other jurisdictions, so they did lower it. In terms of taxes, profits tax in Hong Kong is calculated at 16.5% or at 0% if your tax exemption application gets approved. In Singapore, the profits is actually calculated on a staggered basis. So what this means is that if, for example, you have a profit of 300,000 Singapore dollars or less, you will actually have a lower profits tax rate. The highest rate, though, is 17%. In terms of individual income tax, in Hong Kong, you can have progressive rates, or you can choose to have a standard rate of 15%. And in Singapore, they solely have the system of progressive rates, which is at 20%. Value-added tax. This is something that people really don't realize. In Hong Kong, there is none, but in Singapore, they have what is called GST, which is Goods Services Tax. which is a value-added tax based on the sale of products as well as services. It is very important to understand your transaction flow, whether you're invoicing companies in Singapore, outside Singapore, to understand whether the GST would be applicable to you. So it's very important from the start to have a deep understanding of whether this is something you need to budget for. In Hong Kong, there's no withholding tax. For some transactions, there might be a royalty tax, but this really depends and is very specific, case by case, whether it will be imposed on companies. In Singapore, there is withholding tax on royalty fees, licensing fees, etc. There is no dividends tax in either jurisdiction. And as I had mentioned earlier, in terms of the tax exemption applications, you can apply for this in Hong Kong, regardless of where your bank account is. In Singapore, however, you can only apply for tax exemption if the bank account is outside of Singapore and if you follow the criteria of having an offshore status. In this slide, I wanted to show what is the actual maintenance work that you need to consider when you're setting up either entity. This is something a lot of clients forget to ask when they're speaking to corporate providers. And here I wanted to clarify what you need to do in Hong Kong and what you need to do in Singapore. So on an annual basis, if you have a virtual office concept, what you need to do is you need to renew the fee with your corporate service provider for the company secretary and the registered office address. Local director, currently in Hong Kong, that's not required. In Singapore, a local resident is required to have. So again, this will be an annual fee that you will need to pay with your service provider. You need to file an annual return and an AGM every year. You will have to do an annual audit every year, whether it is unaudited accounts or whether it's audited accounts. You will have to do a director's report in both jurisdictions. And something which is different is that in Hong Kong, you will have, you don't have to do this XBRL filing. Let me explain what that is. You actually, in Hong Kong, will have an accounting software system which will be used to input all your accounting data. You then produce from this your financial statements, and these are submitted and reviewed for the annual audit. In Singapore, they have an additional step. You'll have your accounting software system. You will then have to convert this data into an XBRL filing, which is then converted into your financial statements, which are then submitted. So you have to do this additional step in order to be compliant. And in both jurisdictions, you do have to do annual filing for your tax return as well as for your employer's tax return, which is standard. The double taxation agreements, this is something that's very different in both jurisdictions. And if you are a very large company and you really need to consider your international tax planning strategy, then the double taxation agreements will come into play. In Hong Kong, there are currently 27 agreements that have been signed, of which there are still 5 which need to be ratified. In Singapore, there are 69 agreements which have been signed. Both jurisdictions have DTAs with China. I have listed here, for those of you that are interested in market entry into China, whether using Hong Kong or Singapore, I've listed here the comparisons of the DTAs, the most important points. There's only differences in the interest and royalty sections. Something I do want to point out, which has been very interesting in the last 3 months in China, is that the tax bureaus are becoming much more stringent on repatriation of licensing fees, marketing fees, royalty fees, etc. The Chinese Tax Bureau will investigate whether your Hong Kong or Singapore entity has substance. And this is something that's very important to actually show. If your company in Hong Kong or Singapore is purely a holding with no employees and no activity, then you will not be able to obtain these rates. So if you have a licensing fee and you have your trademark registered with your Hong Kong or Singapore entity, then that's fine. There's substance. You have the proof that your trademark is registered in Hong Kong or Singapore and that these then licensing fees are valid. If your trademark is not registered in these jurisdictions, then you won't get these rates for the withholding taxes. Something that a lot of my clients forget to do or don't even take into consideration during the phase of entering the China market or even the Hong Kong or Singapore market is international tax planning. This is something that really should be done from the start in order to then create the appropriate structure for your business model. Many of our clients are larger entities that really do need to take double taxation agreements into mind if they want to do tax optimization strategies. As such, usually the trend that we have found is that for very large companies, whereby there's no DTA in Hong Kong, they will utilize Singapore because there is such a network of DTA agreements that have been signed for many years and have been well developed. In Hong Kong, the reason that the number of DTAs is so low is that Hong Kong only amended its Articles of Association for the exchange of information about 3 years ago. And since that period, it went from having 5 DTAs to now having 27. And it's the one country in the world where the development of DTAs has been phenomenal and so quick. And I believe that there are many more that are under negotiation at the moment. The next question that I get asked is, what is the status regarding the RMB offshore centers? Everybody realizes that Hong Kong is the first renminbi offshore center. It's the most mature market for the RMB on paper. Now, I have been talking with a lot of my clients that are trying to do transactions in RMB out of their Hong Kong entity, and the plug comes in with the banks. Although the banks say that they are completely open to doing RMB transactions and Hong Kong has huge RMB deposits, on paper there should be no problems in doing currency exchanges, either from foreign currency to RMB or RMB to foreign currency. It's just the banks don't have proper implementation policies in order to be able to do it. And many clients that have tried to do RMB transactions with China have just not been successful. I assume there will be improvements in the banks, but it all comes down to each bank's internal policy on how this will develop. Now, many of you may have read in the newspapers about Singapore or London being the next renminbi offshore centers. The latest news that I have heard, and this is on the rumor mill, is that the next clearing platform for RMB exchange will actually be in Singapore. So currently, Hong Kong has the only clearing platform, which is with the Bank of China in Hong Kong. The Bank of China is the only bank that is allowed to do the physical exchanges of foreign currency to RMB and RMB to foreign currency. And apparently the next one will be in Singapore, either with the Bank of China or with ICBC. I believe they're both bidding for this capability. Having said that, I do also believe that London will be coming up. They may not have a clearing platform, but they will be definitely coming up in terms of having RMB deposits to have the capabilities to do exchanges. So I wouldn't keep London out of the way. What are the trends that I see amongst my clients? And I can only really make this trend analysis based on the clients I have and the decisions that they have been making when they enter the Asia-Pacific market. From what we've seen is that clients use Singapore as holding structures or as physical trading entities if they are dealing with Southeast Asian countries like India, Malaysia, Thailand, Vietnam, Bangladesh, or Indonesia. And generally, Hong Kong entities are used for East Asian countries such as China, Japan, Korea, Philippines, or Australia. This is a generalization, but this is a generalization made up of Clayco Group's clients and the decisions made by Clayco Group's clients. It shouldn't be taken as something you must do. Again, it should be based on your business model and what you believe is the best jurisdiction that fits your business model. But if you are only doing business in Southeast Asia, Singapore is obviously a lot closer than Hong Kong is. And if your majority of your business is in China, then obviously Hong Kong is the best jurisdiction. Something that was very interesting for me on my trips to Europe was the fact that many law firms and corporate service providers were explaining to me that Singapore was the general jurisdiction to be used because for Europeans, Singapore is a closer country. It's more westernized, and in their minds, they believe it's more simple than Hong Kong is. In addition to that, Hong Kong for them is China. It's not one country, two systems. It is purely China, and there's great fear on establishing Hong Kong entities for this fact. Many people have the concern what's going to happen in 2047 when it will all become one nation. So this is something that keeps popping up in their minds. A third consideration that has to be made when doing business in China or doing business in other Asian countries is the existence of these DTAs. And you need to make the decision whether international tax planning should be done now or whether you should be doing it later on, and whether these DTAs should be taken into consideration. My suggestion would be to talk to your tax advisors back home and discuss with them whether this is something that needs to be taken into mind now, and whether there are any tax optimization structures that can be created now for the long-term period. It is a nightmare in 5 to 10 years to restructure entities for tax optimization techniques because now with the changes that are occurring in the US and in Europe, everything is becoming more difficult, more transparent. So it's better to create structures properly right from the beginning. That is actually the end of our presentation. I have a couple of questions here that I will just answer. So one of the questions that I have is when does the first audit have to occur? In Hong Kong, the first audit which has to occur is usually either after the first 12 months or 18 months of establishment. In Singapore, it's actually a very similar regulation as well, where the first audit report also has to be after the first 12 months or 18 months of establishment. The next question I have is, hypothetically speaking, in the next 10 years, in my opinion, what would be the best Asia location for global trade? This is actually a very good question to ask. And I will give you what my answer is and what my opinion is. I think both Singapore and Hong Kong will grow simultaneously. I think Singapore is a little bit ahead of the game compared, I believe Hong Kong is a little bit ahead of the game compared to Singapore. But Singapore is catching up quite well. If you look at all the tax rates, each of them are competing against one or the other in terms of lowering the tax rates. It's quite funny to see how government decisions are made. If Hong Kong changes its mind and changes the rate, Singapore will actually automatically follow. In 10 years' time, I think it really depends on how China's development will be. China is opening up, and if you're doing business with China, I still believe that Hong Kong will be a vital location and something that you can't be without if you're doing business in China. The trend that I have seen in the last 18 months is that companies are asking us how to sell in China versus how to actually source in China. And this has become quite interesting because companies are not only looking to sell into China, but also the whole Asia-Pacific region. And at that point then, considering whether you set up in Singapore or whether you set up in Hong Kong is a very good question. Now, my answer to this would be if you are actually, if your main target market is China, then my suggestion would be first to set up in Hong Kong an entity. If your target market is not China at all, but it's all the other Asia-Pacific regions, then I would do it out of Singapore. But again, this is related also to the DTAs and how this will affect your parent company. So there's actually a lot of considerations to make. One question I have gotten from one of my clients is, if you're considering to send expatriates to Asia, is it easier to send them to Singapore or is it easier to send them to Hong Kong? Actually, in both cases, it's identical. The standard of living is very comparative. Hong Kong is slightly more expensive than Singapore. If you have children, the schools, the international schools, both in Hong Kong and Singapore, there's limited capacity. So you do need to reserve places for your children in advance in order to be able to get them in. If you're looking at pollution levels, obviously Singapore has a much better quality of life and environment compared to Hong Kong, just on the basis of the pollution issues. But other than that, both locations are the same. If you're planning on hiring staff, the quality of staff in Hong Kong and the quality of staff in Singapore, in my mind, are identical. It could be that in Singapore they're slightly more westernized, but really in my mind they're both the same. Very hard workers whose English levels are very good, and their backgrounds, university levels, etc. are quite high. Another question I've had is, what about exit strategies? Is there any advantage to either country? The exit strategies are actually the same in both countries. If you're looking to liquidate your entity, you do need to have a certain period of time where you are, so to say, dormant, where there are no transactions that are running through your bank account. After this period of dormancy, you can then start the application for liquidation. Something to keep in mind, because a lot of people misunderstand this. When you want to liquidate an entity in either Singapore or Hong Kong, you need the shareholders' decision, but it's not something that can be done overnight. Usually it takes about 8 to 9 months to do a full closure. Another question was whether you could change the fiscal year in China and Singapore. Actually, in both locations, you can choose your fiscal year. So you can choose a January to December calendar year, or you can choose July to June, or March to February, as you wish. There's no difference between both jurisdictions. I have a very interesting question here in regards to whether you should structure 2 entities depending upon your trade development. Let me base this on Clayco's growth, because we started off in Hong Kong based on the fact that my father was in Hong Kong and he developed his business here. After that, we moved into China because that was really the growing market of where we needed to be. We have added Singapore into our portfolio of jurisdictions for the fact that we see that it complements Hong Kong. We're starting this office very small. It's going to be a small growth, but we find that it's vital to have this office in order to be able to compare both jurisdictions and to be able to advise clients on what is the best option for them, whether it's Singapore, whether it's Hong Kong. If you're looking at global trade options, I wouldn't do both at the same time. Start off with one jurisdiction, see how your development goes, and if you really feel that you need to have a Singapore entity in order to be closer to your clients in the Southeast Asian countries, then do so. But you may want to start it off only with one person. Obviously, if you have 2 entities in the region, additional costs apply, and they may be doing the similar type of sales initiatives. So You need to weigh out the costs, whether it's better to have a sales staff based in Hong Kong who just travels to Singapore and the other countries, or whether it's important to have a sales office in Singapore and have people travel out of there. That's really more a cost analysis to see whether it really makes sense to have both entities or not. I hope I've answered all of your questions. If you're interested in discussing this issue more, I would be more than happy to schedule conference calls with you individually to also discuss your personal business structures or business models. To give you, my contact details are listed here. Sven, who is based in our Hong Kong office, can also be reached. And like I said, we would be happy to discuss it on an individual basis. I hope you enjoyed today's webinar. Please do contact us again, and please do join us also for next month's webinar, which is listed on our events section already on our website. So thank you for joining, and I wish you all a very pleasant day and a happy Chinese New Year holiday period. Thank you, and goodbye.